You've probably heard these terms before: index funds, mutual funds, hedge funds, ETFs. They all sound kind of similar, but they're actually very different. In this video, we're going to break them down one by one: how they work, how they're managed, the risks involved, and who each one is really meant for. Because when it comes to investing, understanding these four can completely change how you build wealth and how fast you get there. And just a quick note, this video is for educational purposes only and not financial advice. Let's get started. Before we compare them, let's make sure we understand what a fund actually is. Think of it like this. Imagine you and your friends want to throw a huge party. Instead of one person paying for everything, everyone chips in a bit of money. Together, that pooled money can cover food, drinks, music, everything you need. That's basically what a fund does, but for investing. A group of investors pool their money together, and that money is then invested in different assets, like stocks, bonds, or real estate. The key advantage is diversification. Instead of buying one or two companies yourself and hoping they do well, a fund spreads your money across hundreds, sometimes even thousands, of investments. So if one company fails, it barely moves the needle. Funds also offer professional management, meaning you don't need to be watching charts or earnings reports all day. Someone else, or something else, is doing that for you. And finally, funds give access. You might not be able to afford a full share of every company in the S&P 500, but through a fund, you can own a small slice of all of them instantly. All right, foundation set. Now, let's go through the four main types of funds and what makes each one unique. Let's start with the one that changed the investing world forever: index funds. An index fund is a type of investment that simply copies the performance of a specific market index. So instead of trying to pick winners and losers, it tracks a list, or index, like the S&P 500. The S&P 500 includes 500 of the biggest and most stable companies in the US: Apple, Microsoft, Amazon, Coca-Cola, and hundreds more. When you invest in an S&P 500 index fund, you're automatically investing in all those companies at once. If the overall market goes up, your investment goes up. If it goes down, you go down with it. Simple as that. But here's the key. Index funds don't try to beat the market. They just aim to match it. This passive strategy completely flipped traditional investing on its head. For decades, fund managers tried to outsmart the market, charging high fees in the process. But study after study proved something shocking. The majority of them failed to outperform a simple index fund over the long term. That's why legendary investors like Warren Buffett recommend index funds for most people. He once said that if he could give one piece of advice to everyday investors, it would be this: put 90% of your money in a low-cost S&P 500 index fund and 10% in short-term government bonds. Why? Because index funds have low fees, low effort, and consistent performance. Most index funds charge an expense ratio between 0.02% and 0.20% per year. If you invest $10,000, you might pay as little as $2 a year in fees. That's basically nothing, and over decades, that difference compounds massively. One small thing to note: index funds are priced only once per day, after the market closes. So if you buy at 10 a.m., your trade executes later at the net asset value, or NAV. Not ideal for active traders, but perfect for long-term investors who just want to set it and forget it. Next up, mutual funds. They're older, they sound similar, but they work a little differently. Mutual funds also pool money from many investors and invest across multiple assets. But unlike index funds, they're usually actively managed. That means a professional fund manager, or an entire team, is picking what to buy, what to sell, and when to do it, all in an effort to beat the market. In theory, that sounds like a great deal. You get experts making all the decisions while you sit back and relax. But in reality, it comes at a cost, literally. Mutual funds charge much higher fees, typically between 0.5% and 1.5% per year. And that doesn't even include potential sales commissions, also known as loads. And here's where things get tricky. The vast majority of mutual funds don't actually outperform the market in the long run. Even with all that expertise, they often lag behind simple, low-cost index funds. A famous SPIVA report by S&P Global found that over 85% of actively managed U.S. equity funds underperform the S&P 500 over 10 years. Still, mutual funds have their place. They offer more customization. You can find mutual funds that focus on specific industries, countries, or investment styles. Some aim for income, others for growth, and some try to balance both. They're especially common in retirement plans, like 401ks or RRSPs, because they've been around for decades and are often offered by default. Like index funds, though, mutual funds are only priced once per day. So if you want to buy or sell, you have to wait until the end of the trading day for the price to update. So think of mutual funds as the old-school version of pooled investing. Good intentions, decent structure, but expensive compared to what's available today. Now let's move to the mysterious, exclusive side of investing, hedge funds. The name hedge originally came from their goal to hedge against market risk. But over time, hedge funds became more about beating the market aggressively. These are private investment partnerships that pool money from wealthy individuals and institutions to pursue complex, high-risk strategies. We're talking about short selling, leverage, derivatives, arbitrage, global macro bets, strategies that the average investor can't access or doesn't fully understand. Because of that, hedge funds are restricted. They're only open to what's called accredited investors, people who earn at least $200,000 a year or have a net worth over $1 million, excluding their home. The appeal? Massive potential gains, but also massive potential losses. Hedge funds operate under what's known as the 2 and 20 model, a 2% management fee plus 20% of any profits the fund makes. So if a hedge fund manages $1 billion, it earns $20 million a year just for existing. And if it performs well, the manager takes another huge cut of the profits. Some hedge fund managers like Ray Dalio or George Soros have become legends. Their funds earned billions for investors, but many others have collapsed spectacularly. Hedge funds are high risk, high reward. They can generate huge returns when markets are volatile, but they're not built for the average person. They're designed for people with deep pockets and the ability to stomach heavy losses. Finally, we have ETFs, or exchange-traded funds, the modern evolution of index funds. ETFs pool money from many investors, just like index funds, and invest it into a portfolio that tracks an index, a sector, or even a commodity like gold. But unlike index funds, ETFs trade on the stock exchange, just like individual stocks. That means you can buy or sell them anytime during market hours. Their prices fluctuate throughout the day based on supply and demand, giving investors real-time flexibility. For example, you could buy an ETF that tracks the S&P 500, the NASDAQ, emerging markets, or even a specific theme like clean energy or artificial intelligence. The flexibility is unmatched. You can use ETFs to invest, hedge, or even trade short-term strategies. And the fees? Still incredibly low. Many ETFs charge expense ratios as little as 0.03% per year. Some ETFs are passive, like traditional index funds, while others are actively managed, giving you a mix of both worlds. ETFs also have tax advantages in many cases because of how they're structured. When investors buy or sell ETF shares, it doesn't usually trigger taxable events inside the fund, unlike mutual funds, which often distribute capital gains. That's one reason ETFs have exploded in popularity over the last decade. In 2003, there were just over 200 ETFs in the US. Today, there are more than 3,000, with trillions of dollars invested globally. So after all that, which one should you invest in? Well, it depends on what kind of investor you are and what you actually want out of your money. If you're someone who values simplicity, low fees, and long-term growth, index funds and ETFs are almost always the smartest move. They don't try to outsmart the market. They simply become the market. You buy, you hold, you let time and compounding do the heavy lifting. It's how most millionaires quietly build wealth, not overnight, but over decades. Mutual funds, on the other hand, might make sense if you like the idea of professional management and you don't mind paying a little more for it. They can work well inside retirement plans or for investors who prefer a more hands-off experience, as long as you understand that the higher fees often eat into your returns. Now, hedge funds. That's a different world entirely. They're designed for the wealthy, people who can take on more risk and aren't afraid of complex strategies. If you're watching this video, chances are you don't need a hedge fund, and that's perfectly fine. Because even though hedge funds get the headlines, most investors who build true, lasting wealth do it through the basics, not the exotic stuff. And then we come back to ETFs, the modern investor's choice. They're flexible, easy to buy and sell, and available for almost every kind of investment you can imagine. For most people today, ETFs and index funds strike the perfect balance between simplicity, diversification, and performance. So, if you take one thing from this video, let it be this. You don't need to chase complicated investments to succeed. You just need to understand what you own and why you own it. Because in the end, the best investment isn't the one that sounds the smartest. It's the one you can stick with for the longest. If you found this breakdown helpful, hit the like button and consider subscribing for more simple investing explainers. Thanks for watching, and I'll see you very soon.